Welcome to our Superstonk AMA with Nomi Prins. Tell us about yourself.
Well, thank you, first of all, for having me. I'm actually thrilled to be able to talk to all of you. I am a bunch of things. I have written a number of books, seven, soon to be eight coming out when Permanent Distortion comes out. I was a Wall Street, pick your name for it, insider, now outsider, executive. I was a managing director of Goldman Sachs. Senior managing director of Bear Stearns in London, and I also ran an analytics group, mini group at Lehman Brothers, and then I was also at the Chase Manhattan Bank when I started out. I have a doctorate in international political economy, which is just a fancy way of saying that I like to look at what's going on the ground all over the world in order to create my own views as to what's going on here and globally as well. So I get out a lot. I travel often into small towns, big cities all around the planet in order to be able to feel and see and touch what's going on, as well as look at a lot of numbers because I am at heart a geek, a quant.
Let's start off with the Fed and monetary policy. It would be in the best interests of the American people to be granted a much higher level of access and transparency into the Fed. It is difficult, however, to garner the public support necessary to make something like an audit of the Fed possible, made all the more difficult by the general public's ignorance in regards to our financial and monetary systems. What's the best way to counteract ignorance and misinformation? Is there anything in particular you think we can do to generate awareness and public understanding for these issues?
That's an excellent question. And the Fed has sort of been shrouded both in secrecy and also in narratives of its own making since its inception back in 1913. I mean, even when the Fed was just a thought in 1910, it was a thought that was very highly coveted by the major Wall Street bankers at the time, and that's a reality. It's not sort of a conspiracy theory. It was created by a group of bankers in terms of the actual legislation that ran through Congress, and also with one of the senior senators at the time who was head of the Senate Finance Committee. And so from the beginning, the Fed was created to effectively help that contingent of the markets, of the economy, and of society. It was promoted, or the narration behind it was that it would help. That if we had this major central bank of the United States created to effectively allow for liquidity when there wasn't, to help what was said to be the middle of the country, the farmers' banks, the smaller banks throughout the country, when and if there were panics, that would create actually a deleverage of the power of Wall Street. But of course, it was created by Wall Street. And it's always been leveraged on behalf of Wall Street. The New York Fed, which is one of the main sort of power points of the 12 Fed Bank Reserve System, is located like a minute away from what were the headquarters of Chase Manhattan Bank and the Morgan Bank at the time by the New York Stock Exchange. So that center of the most powerful component of the Fed is even located geographically over there. And a lot of people don't necessarily know that, because we talk a lot about the Federal Reserve in Washington because of the FOMC meetings, what's happening to interest rates, what's happening. I think now more and more people are hearing the terms QE, or quantitative easing, but it's still shrouded with a lot of myths, which is, for example, that the Fed can help the economy by buying trillions of dollars worth of bonds and creating trillions of dollars worth of money out of nowhere, and that has, I think, been used to sort of shroud what the Fed really does, which is help the financial system. So I think in terms of how do we get that message out, I think it's just that. To ask the questions, to really ask the questions. Well, how actually is the Fed helping the economy? Is the Fed actually helping the economy? Is what the Fed is doing with rates or by creating money actually helping you? And if the answer is I don't know or no, then I think that's a starting point for opening up that education and that knowledge as to what the Fed is really doing. If the answer is, well, it seems like when the Fed does something or says it's going to do something, the markets move a whole lot, then that's the answer for you as well, that the Fed is there effectively to help Wall Street, to help the markets, and not necessarily to help the economy, though it says that's its job. And so the education has to come by really asking the questions back to those headlines. The Fed's going to fight inflation by raising rates. Well, how? All of those questions help to basically formulate like more education and more scrutiny in terms of what the Fed's doing, and actually calling it out on what it says it's doing and looking what it is actually doing.
Do you think the Fed is serious about fighting inflation, and do you expect them to stick with this conviction if facing a debt meltdown?
I think the Fed wants people to believe that it is serious about fighting inflation. And I think whether it is or not is secondary to that. And the reason it wants the public and also Washington, in terms of the political bodies that be in Washington, to believe it's fighting inflation is because inflation has gotten really high with respect to the real things and real numbers that are out there, and that the Fed measures, for example, the consumer price index and other indices. And we know that the price of food and the price of gas and fuel has gotten very, very high of late. And we also know that the Fed last year said that this inflation in these prices as it was coming into the market was just transitory, which it got completely wrong. But the bigger thing to consider with what the Fed is saying and whether it's actually serious is that what the Fed actually did was it inflated the amount of basically fabricated money in the system. It took its book, its size of assets, the money it created in order to buy treasuries mostly and mortgage-backed securities from a level of about $4.1 trillion before the pandemic, so January-ish 2020, into what is now just shy of $9 trillion. That's a lot of money to create out of nowhere. And again, to the first question, it did that in the narrative of helping the economy, but it can't do things like produce food. It can't do things like create better supply chains. It can't do things like lower the cost of fuel, like lower the cost of gas, like lower the cost of oil. So the message that it's promoting is that it actually has the ability to handle all sorts of inflation. What it does have the ability to handle and didn't do was inflation in the supply of money and in the fabrication of money in order to buy the assets that it did in the last couple of years, and also in all of the years since the financial crisis of 2008, where it also created and used that money to buy treasuries and mortgage-backed securities to the tune of $4.5 trillion. If it was totally serious in reducing inflation of its mode of producing money or creating money, it would cut its book back by a whole lot more than the 95 or so billion dollars that it's saying it will let run off of bonds, not sell, but run off, which merely means that if bonds mature, the Fed won't create new money in order to buy new bonds in order to replace them. Currently, the Fed's book has about $4.5 trillion worth of treasuries and $2.7 trillion worth of mortgage-backed securities that don't mature within the next year. If the Fed were really serious, it would talk about letting some of those run off, but it's not. It's just letting run off what's going to run off anyway, in terms of shorter maturities of what's on its book. And I think at the end of the day, what's going to happen is the Fed will have to recognize that real inflation for real things that real people buy in the real parts of their lives is not under their actual control. And until they're honest with that message, they're basically in a situation where their mode of fighting inflation doesn't really connect to the inflation that they actually created and that they have not admitted that they've created in money, in markets, in financial assets.
So you actually posted on LinkedIn. So if Powell truly wants to emulate his hero Volcker and take tough measures for long-term economic health, he should take a leaf from the Kiwi book and tell the American public and politicians that many asset prices have been pumped unsustainably high by free money. Since it's unlikely that Powell will do this voluntarily, what actions can I take on my own or as part of a group to demand this of the government and the Fed?
Yeah, I mean, that's an excellent follow-up question, because it gets to the core of what the Fed really did, which is that it inflated the trillions of dollars worth of money that are now in the system that have been used to basically purchase treasury debt, government's debt, as well as mortgage-backed security debt, which is the debt of the big banks. And no, it hasn't admitted, and Powell hasn't gone up there and admitted, and this is part of the problem of both the narrative and basically the last three leaders of the Fed, from Bernanke to Janet Yellen to Jerome Powell, that there isn't this admission that when you create money very, very cheaply for the institutions that have the most access to it, well, then the net result is going to be that they're going to use that money to pump up the assets that they have the ability to pump up. And that includes buying their own shares. That includes leveraging their money into the broader parts of the market. That includes greater amounts of leverage for the biggest financial players versus everyone else, which creates inherent instability in the system. Absolutely none of this is being admitted by the Fed. There was one report that came out actually about 2 years ago that talked about how some inequality that was growing, this was before the pandemic, in the actual economy was somehow related to what the Fed had been doing before that. But since the pandemic, and even really in a very deep way, nor Powell nor the rest of the Fed has admitted the extent to which they've created this sort of false financial asset system, which I call being permanently distorted from the real economy, because the real economy doesn't get that money flow. It just has not the ability to access the trillions of dollars that the Fed basically creates, just in terms of how the Federal Reserve System has been established relative to the banking system. And so therefore, just by definition, by math, by just flow, all of that money has gone into pump up assets, which has also distorted the means of evaluating the companies or those financial assets in a more true way. In other words, if they didn't have all this excess money being thrown at them, what would they look like? Maybe some stocks, maybe some financial assets would be priced just as high as they are right now. Maybe they wouldn't. But what the Fed has done, and what Powell has not admitted, is the extent to which that free money, which is still nearly free, even with the last two rate hikes, the 25 basis points and 50 basis points so far, and what it's done basically to distort the value of financial assets and to pump them up.
You have a book titled Collusion: How Central Banks Rig the World. I'm curious to hear you speak to the latest rate hike, which you kind of just did.
I get ahead of myself sometimes.
Largest rate hike in 20 years, but still just 0.5%. What do you think they should be doing that they aren't, and vice versa?
Well, what they should be doing is, since they have bought all these treasuries, and they won't do this, is potentially deploy them in a way that actually funds the real economy, as opposed to having not for one moment had any strings attached to this money, to the quantitative easing finances that they provided to the major banks in this country. There was never strings attached to say, okay, well, if we give you all this money and we take your treasuries off your books, or we take the treasuries from the Treasury Department that go to your books and then go back to the Fed in this sort of triangle of sort of moving debt around for the creation of money in return. That could be something that could have been tried at some point. Some form of accountability relative to the money that the Fed was creating, given it was in such abundance. They didn't do that. They could have done that. I don't think they will do that ever. But that would be one way to at least tie money creation, if it's going to happen, because there is no legal limitation to how much the Fed can create when it wants to. With respect to raising rates, by now 75 basis points relative to what they were before the middle of March. I do think the Fed will continue to raise rates a bit more. I do think that it's likely they'll raise rates by another 50 basis points at the next meeting, and probably maybe another 25 after that, because I do think they're going to start to realize that what they're doing isn't what's actually fixing inflation in real assets. They won't admit this. They'll just say, okay, well, inflation is doing whatever it's doing, but we can't really affect it much more. And in the meantime, we're seeing signs of slowing down in different parts of the economy, and we don't want to be responsible for that. So we're going to wait and see. We're going to look at data. We're going to step back. And they're going to change their language, I think, in the next 2, maybe 3 Fed meetings to indicate that. And I think that's going to be a way they're going to walk back some of those policies, or at least put them back into limbo where they were before the pandemic broke out.
Is the world facing a sovereign debt crisis in the coming months? If so, how should people prepare for that?
The world is currently teetering on almost a 3-to-1 ratio of debt to global GDP. Of course, some countries are doing better than others. Some have a higher ratio. For example, right now, the United States has a domestic debt to GDP ratio of about 130%. Japan's is way higher than that. Some other countries are in between. But the point being that a lot of this debt that has been created at these very cheap interest rate levels has been created in and denominated in US dollars. And what that means is, for example, with emerging market countries and developing countries, is that the bulk of their debt that has been taken out in dollars has to be repaid in dollars. That's one of the reasons the dollar continues to stay high, not because we have such a great debt to GDP ratio or even a great budget to development issue, but just because we have the dollar. And so once that breaks, and I don't think it's in a few months. I think we're a ways off from that because I think this tension is building right now where a lot of emerging market countries have had to push up their rates without being able to create money much higher because they are facing inflation pressures because of what's going on in their domestic borders or what's going on with supply chains or things around the world. So that's happened where their currencies don't buy as much or aren't able to repay as much dollar denominated debt as they could before. And so that's a problem. And so when they start to and what will start to happen is corporations in these countries will start to either default or have more delinquent payments on their debt. And that's going to impact their sovereign debt because that's basically money that's going to deteriorate, going to fly out of, say, investments in those companies because their debt doesn't look so good because they can't repay what they borrowed in dollars. And that's going to have an impact on the larger nations, the broader nations' ability to pay back that debt. So we've been teetering on this edge of a sovereign debt default for quite some time. It's just that we've also been, as a world, not just the Federal Reserve, but the ECB, Bank of Japan, and so forth, creating all this sort of money around it to sort of push that can down the road. And as long as we're still doing that, which, as I said before, I think we will be, even if we raise rates. When I say we, I mean the Fed raises rates, or even the ECB raises rates from like negative in the near future. I think net, that the availability of money into the major countries is so high that they're going to continue to be able to push off even a slight increase in their debt repayments. And so we may wind up seeing smaller countries default, but we're not going to see a major debt crisis within larger countries because they're still producing and relying on all of this money they've already created.
Central bankers are saying that central bank digital currency will not be used as a new monetary policy instrument, nor as an excuse to abolish cash. Is CBDC on your radar, and what do you expect from it?
That's a really great question, and it falls under this category of watch what they do and don't listen to what they say. And right now, I think one of the biggest areas of hiring inside, for example, the European Central Bank and even the Federal Reserve, is for the area of digital currency. So whether that's analytically or from a programmatic standpoint or what have you. So whatever they're saying, they're actually hiring opposite to that. So I do believe that central banks, for a couple of reasons, the major central banks want to have a digital currency. One is actually to have power over their private banks with whom they also have strong relationships. So for example, if the Fed were to initiate a CBDC, then they would be able to actually control a larger slice of a financial activity that's now the domain exclusively of the big private banks. So for example, people who want to just work with digital currencies and not go through a regular bank, the underbanked who might have a different avenue towards some sort of a Federal Reserve Bank setup or something like that. So the Fed basically has a means of kind of reaching potentially more people with a digital currency than they have right now, which is ironic because they are, again, symbiotic with the big Wall Street banks, but there's a little bit of competition there. And the other thing is there's a competition with cryptocurrencies, there's a competition with Bitcoin. I mean, right now we have a situation where Bitcoin has been slammed, as have a lot of other cryptocurrencies in those markets. But the whole reason that Bitcoin became as prevalent, or a major reason Bitcoin became as prevalent after the financial crisis of 2008 as it did, and why the white paper that sort of launched it was as monitored as it grew as it did, is because it was a defense against what central banks were doing with respect to creating money, as we were talking about. And so this defense, this idea of having more of a decentralized financial system, and using that to basically take sovereignty or take power away from the Federal Reserve, away from big banks, has not gone away. What's happened is, and I do think we need better regulations of some of the cryptocurrency markets, and also something of a deposit insurance. So I do think there needs to be a way of creating a less volatile path towards using Bitcoin in more places, because if that can happen, then it can be more prevalent globally. And if that happens, which the Fed and other central banks are afraid of, then them having a digital currency is a way to sort of combat or defend, or just grow around that potential expansion of Bitcoin or other cryptocurrencies. And we're kind of all in the new innings of this. This is all sort of a beginning process in terms of just financial history. But for those reasons, I think that the Federal Reserve and other central banks are looking at, and I am looking at, digital currencies, and I do think that ultimately they will happen.
What does the current utilization of Fed overnight reverse repo loans actually tell us about the health of the market? And what will cause the utilization of overnight reverse repo loans to decrease back to pre-COVID QE levels?
So just to unpack that, reverse repos are basically the Fed's way of draining money out of the system. So basically selling these securities into the market, or borrowing and then selling securities into the market for banks that might be involved in reverse repo, and then getting cash, and then that basically tightens that relationship between treasuries, or short-term treasuries, short-term loans, and cash. And it's crazy right now. It's like at $2 trillion. I mean, it's at just obscene historical levels. And one reason for that is the Fed's trying to really increase interest rates in lots of different ways besides just moving them upward. So it did move rates up the 25 and 50 basis points, and it'll continue to do that for the near future. And then I think it'll stop, as I said, but it's kind of letting some bonds roll off its books, but not in a really big and meaningful way. And so reverse repos is kind of the third way of the Fed intervening in the markets and in the market system in order to try and raise the rates of the front end of the curve. So it's like one of the three ways it does that. The Fed's really not supposed to be involved in the repo market. This again goes back to the New York Fed, who's charging ahead with this, and it's doing so because that's what Wall Street wants right now. A place to basically park their cash and get it back later, and that's what's going on right now. So the later will happen, and how will this reverse? It will reverse when the Fed decides that the short end of the curve, that rates are high enough, or that it doesn't want to continue to send the message out or do anything about raising rates or reducing the size of its book, because that narrative changes to there's not enough liquidity, or the economy's slowing down, or whatever, that allows the Fed to basically go back to where I think it's more comfortable, which is in keeping rates low and helping the markets be pumped up, and everything else. So that's the time at which reverse repo is going to come down.
Is there like a limit to the reverse repo, or no limit?
No, I mean, the thing about all the weirdness that has to do with the Federal Reserve is there were never any limits to anything. Even the fact that the Fed could still technically, and they haven't, but reduce rates to negative, as the European Central Bank did. There's no limit there. There's no real limit on how high they can raise rates. There's no limit on how much money they can create, or how many assets or which assets they can buy with that money, whether it's treasuries or mortgage-backed securities. There's a slight limit on the quality that they have to be highly rated, because that's basically what's going to flow the easiest back and forth between the government and the Wall Street banks and the Fed. But that's like the only minor restriction. And there's no limitation on how much activity they can do in the repo markets. Back in September 2019, they were on the other side. They weren't doing reverse repos, they were doing repos, and they were basically giving money to Wall Street and effectively reducing the level of rates that way. So that was kind of the backdoor to that three-prong approach to manipulating rates and the cost of money. And now they're on the other side of that. None of that has a limit. So I don't think that even at the time where the Federal Reserve was just conceived, even in thought, did anybody there, including the bankers, think that it would have such power to basically do whatever it wants to with respect to money, without official legal limits.
Wow, that's crazy. Okay, so we're going to touch on your previous career a little bit. So working for Lehman Brothers and Bear Stearns, could you share any information that never reached the public or that the public doesn't know regarding the two companies and their connections with the 2008-09 recession? Also, what similarities are you seeing with current companies and banks or overall market now that you saw before and during the recession in 2008 and 2009?
So I don't know how much this is widespread, known or not known, but one of the main things that happened with both of my two of my former employers, Bear Stearns and Lehman Brothers, was that in the run-up to the financial crisis, they were leveraging, or they were basically borrowing lots and lots of money from the bigger banks. So from JP Morgan Chase, for example, and they were using that money to buy the very risky parts of basically CDOs or sort of engineered groups of subprime mortgages mixed with derivatives and all sorts of other internally leveraged things within a package that they didn't borrow money or leverage themselves to purchase. And the idea that Bear Stearns and Lehman had was that at some point they'd either get rid of these securities, so they wouldn't be off of their on their books, and they'd be able to repay that margin or that leverage, or well, that was basically their hope. There was no or. And what wound up happening was, as they got closer to a boiling point, and Bear Stearns got there first in March of 2008, so before sort of everybody knew about the main financial crisis in the fall of 2008, they were in a situation where JP Morgan and other major institutions weren't willing to renegotiate any of that leverage, mostly because they didn't want any of those securities back. Even a portion back, and plus those securities were losing value so quickly that more would have had to have been put back to them in order to make good on the margins, and they just didn't want those securities. And I think that story wasn't really told. And as a result, Bear Stearns went bankrupt, and Bear Stearns became part of JP Morgan Chase for, at the time, and it went up a little bit after the initial deal, what was $2 a share. I felt that personally because I've been at Bear Stearns, and part of how they compensate, how Wall Street in general compensates senior management is with stocks and options and all sorts of other devices, and sort of a long-term connection into their shares by that way. And so when my sort of retirement was moved to a $2 a share price, and everything else related to that was shifted downward. That's how I personally was involved in that, after I'd left the firm years before that, as were a lot of other people. It's not necessarily to say that that's what also caused JP Morgan to not want to renegotiate some of those lines, but certainly there was ability to get a company and its analytics and whichever people they wanted to keep very, very cheaply. And so that was like the precursor to the financial crisis. It kind of set the stage. And then the same thing happened again with Lehman Brothers. And Lehman Brothers didn't have a big bank buy it. Merrill Lynch did. Merrill Lynch was bought by Bank of America. And at the time, Merrill Lynch was headed by a Goldman Sachs former president, John Thain. And he basically negotiated a deal where he got a large sort of bonus, as did his people at the top of Merrill Lynch, and they just sort of like migrated into the Bank of America fold. And so there was a lot of that going on, and in a way, and I just saw this now, it's like the financial crisis was a big merger and acquisition opportunity for the big banks that survived, for Bank of America, for JP Morgan Chase. Goldman Sachs didn't acquire one of the banks in that environment, but a former Goldman Sachs exec was running Merrill. A former Goldman Sachs CEO and chair, Hank Paulson, was running the Treasury. The CEO at the time, Lloyd Blankfein, was presiding over a lot of risk and a lot of exposure, and was very active, had the most number of, I think, phone calls with basically senior people in Washington to plead his case. And so forth. So, and I have a lot of that in All the President's Bankers. I went through all the phone documents and everything else to just sort of tie into what I knew was happening, but just with actual information that was publicly available. And so that was what was going on too. There were so many personalities and egos and big companies mired in the subprime, what was called subprime crisis, but was really a crisis of leverage and power. That's one of the major stories that I still don't think has been told too broadly out of 2008. And why that's important now is because a lot of these institutions, even though they haven't had like a major crisis since then, they've just done things like paid fines for securities breaches and rigging LIBOR and all sorts of other things. But in terms of like a big financial crisis type event, it hasn't happened since then. But they still preside over a lot of trading and a lot of derivatives and a lot of leverage right now, and a lot of engineered securities and a lot of debt that's manufactured and remanufactured. And they're headed by some of the same people that were there at the time. Jamie Dimon still heads Chase. He was there at the time negotiating on his behalf. David Solomon heads Goldman Sachs now. He was running the credit area when I was working at Goldman Sachs, so everything that relates to credit derivatives on up. And now he's the CEO, but he was very aware and very much involved in conversations with Washington. I don't know about the subprime crisis in particular, but certainly he had visits to Washington back even when I was there. So all of that is a part of what generally makes not just bailouts, but the relationships and everything that happens that's bigger than bailouts continue to occur, and the risks continue to be ignored as it's building up in these institutions.
What were the biggest things that drove you away from your previous position inside the industry?
I mean, a lot of that. I mean, a lot of those sorts of power plays that were going on when I left the industry, which was a while back now, in the wake of 9/11, when I'd been working at Goldman that day and around that time, and during that time and into just after 9/11, there was a lot of credit, a lot of debt, a lot of engineered securities that were basically being moved about from balance sheet to balance sheet for various corporations, and also with respect to Goldman's trading desks, there was a lot of pressure, and it wasn't just Goldman, it was throughout the markets to do whatever could be done to basically sell positions that were underwater to clients or ahead of clients in a way that grew tremendously in that early 2000s period, which is ultimately right after which I left. And so there was that. I think there was a real, and the Wall Street banks were always sort of for themselves, but there was more of a pretense and even an action, towards clients relative to the corporations themselves that really dissipated in the late 90s and early 2000s. And I was very much into quantifying risk and talking about the downside with customers, with clients, because I thought that the best way to be the most honest and transparent was to not just talk about what happens when everything goes up and a transaction works and a trade idea benefits, but what happens when it doesn't. How can you be hedged? How can you prepare? And how much can you lose? And that whole idea was very much downplayed in those end years, and even at Goldman, when I wanted to spend more time on analytics that did evaluate those sorts of downsides risks. That was not something that was emphasized internally either for customer.
Wow. So we're going to talk a little bit about legislation in the DOJ investigation too. Is there any hope of reinstating the Glass-Steagall Act?
No, I wish there was. I have been working on trying to get, in different ways, the Glass-Steagall Act reinstated for the last 20 years. I have been on committees to look at that. I have had educational sessions within Congress. I have worked with people in the Senate and Congress to try and adopt legislation that would actually break up banks, that would actually reduce their ability to both be insured by FDIC insurance on their customer side, and also be able to trade, or have these mega asset management or insurance footprints on the other side, because it continues to be a risk to the system. And the 2008 crisis show that in spades. And the Dodd-Frank Act that came out of that crisis, I thought was incredibly weak. I've written a lot about that in a lot of places and talked about how that really just trimmed some edges of some trading, and it didn't summarily divide those major functions of investment banks. And so we still have a situation where any investment bank can plead on behalf of their depositors and say, well, if we go under, we're not going to be able to service all our customers, or their deposits will be tied up, or whatever. And so that risk still exists. I think I've worked with Bernie Sanders on a lot of different types of approaches, and had a lot of conversations there. And he was certainly a champion in trying to get Glass-Steagall brought back. And he was someone who voted against the repeal of Glass-Steagall. And I do think that we're at a point now where what the Federal Reserve has done, has been able to do on kind of a separate aspect, and but related to what we were talking about before, is just whitewash the risk that the banking system imposes in its current format, to such an extent that the appetite for even discussing Glass-Steagall in Congress and in the Senate, with the exception of a very few politicians now, actually on both sides of the aisle, but a very few, it's just not there. And so it would so when I say we'll never come, if we had a major other catastrophe from a financial perspective, where like every single trading desk in the biggest companies on Wall Street had been proven to have colluded together to totally like buy the market relative to other, I mean, there would have to be some, and there was an economic crisis and a financial crash, and a lot of things happening at the same time. Maybe we readdress it, but the moment to readdress it was after the financial crisis of 2008, and what happened was just not anything like bringing back Glass-Steagall. And the narrative has moved in such a way that all of these banks that were recipients of Glass-Steagall repeal, in terms of becoming bigger and becoming more diversified and being in control of more financial services and way more money, are basically saying, well, it wasn't our fault that there was a financial crisis. JP Morgan Chase, yeah, what, we're big, we're diversified, wasn't our fault. We didn't even need the money, which they took. And so there's a lot of narratives that have really shifted away from this idea of needing a new Glass-Steagall to come back. And I hope it continue to be pushed. I mean, every so often I do feel there's energy behind that idea, or energy at least in breaking up some of the major derivatives positions of some of the larger banks. But I think the time was so much more inviting in the wake of the financial crisis than it is now, that we would need another crisis to really bring up that conversation to that level. But I'll keep fighting for it.
Yeah, good. I know.
It's what's needed and what's real. I'm just, I'm trying to look at both sides of that.
Mm-hmm. What's your opinion about the current DOJ investigation on short sellers? Do you think major players will really feel pain, or are we more likely to see justice be relegated to a couple of fall guys?
Well, if history is any guide, the latter. What might happen is the bigger players will have to pay some fines, and we'll do these sort of settlements where they don't really admit they did anything wrong, but they sort of settle for some kind of fine, or they're slapped with some kind of fine that relates to certain activities that they did specifically, which will be a fraction of what they made and what they can make, and their assets and everything else. So just like the fines that were levied in the wake of the financial crisis relative to subprime and credit derivatives and other sorts of activities, then they'll be minor for the larger players. I don't think the larger players are going to really have to change what they do or how they provide leverage to short selling as a result of that kind of finding and that kind of settlement process. And yes, it's true that both the SEC and the DOJ have a history of levying the sort of larger types of fines and rulings on the smaller players to basically because they're basically easier. It's just really easier to go after smaller players than to tangle with a Goldman Sachs and their legal team, or JP Morgan and their legal team when or even like a large hedge fund and their legal team, because at the end of the day, they just have it'll just wind up in settlement anyway. And so, sort of bang for the buck in that respect is less. And I think what we're seeing now with short selling is very similar to what happened in that regard in the wake of the subprime crisis, which is that at the end of the day, there just wasn't enough manpower or will to really analyze the real chain of activities and follow the money and all the people that were involved and what they really had to have known in order for it to move that way, than what wound up happening.
Yeah. You're not the first person to say that about that, the whole mandatory arbitration kind of, yeah.
It's unfortunate. I mean, it's just how it is. I remember in the wake of the financial crisis, I was at some housing conference, and I was sitting next to an FBI agent who had, her team had done a lot of work on some of the documentation into the subprime crisis of some of these banks, and I was having that exact conversation, like just just between us girls here, like what why can't. And her point was like, we just get stonewalled. I mean, there's a point at which the amount of work and the amount of manpower and the amount of analysis that it would take to get to what we need to get to is just too high. And it just sort of gets pushed aside.
Yeah. Can the Department of Justice or any government agency reach criminals who have used derivatives transactions or swap transactions in overseas affiliates to net against short positions in the US to avoid marking orders as short?
So again, this goes back to whether they have the manpower and the will and the data tracking abilities and the teams to want to do all of that. I mean, is it possible? I mean, can you actually follow a chain of short selling through offshore accounts? Yeah, I mean, you can, but you have to know about them. You have to know where it's going. You have to know the timing. You have to watch the flow. You have to have the people, and you have to sort of stick with that case. And so, so there might be some. Again, this goes back to the smaller players versus the larger players. So it might be that with respect to some of the smaller players, that chain is apparent enough or easy enough to follow, such that whatever is retrieved or whatever fine is paid against that process makes some sort of sense in the overall scheme of work and time and hours and the magnitude. But again, for some of the larger players, there's a lot more ways to move money around. And that might basically be more complex than the firepower that would be allocated to find it.
Yeah. Do you think the SEC is an underfunded but well-meaning agency?
That's a really good question. I stopped at that one as I was reading through them initially online, and I have known people at the SEC who I truly believe were well-meaning. For example, Robert Jackson, who was a former commissioner, he's now an NYU law professor, and he used to work at Bear Stearns back in the day. And I had a meeting with him up at the SEC a number of years ago when he was still there, and we were talking about sort of following some various activities. And he said, you have no idea how many actual physical boxes of paper and documentation is like in a basement here at the SEC, and how we would have to hire all of these interns and then direct them and everything else to actually come through it. and he was quite frustrated about the potential of that happening. So as a body, that kind of thing implies that the SEC is underfunded or misdirected. When the SEC was first created, it was run by someone who was very involved in a lot of moving of money around on Wall Street, who was appointed by FDR to run the first SEC, Joe Kennedy. But since then, I think what's happened is the SEC has just not been able to keep up with the complexity of finance. And it's not able to hire people to do that, because anybody who actually really could get ahead of complex engineering or moving money around or whatever it might be is probably doing it for a larger amount of money at a different firm versus working at the SEC. So, but that said, it could attract people who again do care about what the SEC is supposed to be doing. But from a funding standpoint, it is limited, and it also seems like it's limited from a just red tape standpoint. And as a result, just like what we were talking about before, the DOJ, the SEC tends to slap disproportionate fines on smaller players versus watching larger players more closely as they're in the process of potentially committing infractions or crimes or just sort of large amounts of risk building up into the markets or into the economy or into the financial system.
Yeah. Last question. This has been so good so far. It's about GME. I would love to hear your opinion on what could potentially happen if an entire company's float were to become directly registered.
Well, we have more transparency as to their value, right? I mean, the idea would be we would have a better picture as to what a company's shares and debt to their earnings, to their assets, to their revenues actually are, which would give us more transparency in the system, and that would be a positive. I do see a question here, or a comment, which I just, if I could, which is, so is there too much crime for anyone official to do anything about it? And that does get to the core, yes, of what's going on. There's a lot of sort of different kinds of crimes that are happening, or different kinds of just sliding around the edges of what's intended versus what the law is. So there's loopholes, there's crimes, there's sort of a combination of things, and yes, a lot of them are so large. We go back to anything like even Madoff. I mean, a lot of them are so big that while they're happening, there might be red flags coming up, and there might be individuals at the SEC or DOJ or privately who are actually paying attention and watching this. But then there's also a lot of other growth of crimes and these sort of just on the border types of nefarious activities going on, or legal loopholes that are dangerous going on, that attention just doesn't filter into capturing a lot of that.
Well, that is all of our questions. So thank you for coming to our Superstonk AMA.
Thank you for having me on. And honestly, I'm just happy to be able to share. So I am glad you guys contacted me and we made this happen, because I'm just happy that more information can come out, and whatever happens with it is positive.
Yeah, our community is
so I thank you too.
Yeah, to be able to talk to you. Like someone from our community actually reached out to your people and then reached out to us to let us know, like, oh, she will do it. And so that's how we got involved with that. But yeah, no, I actually downloaded your book on Audible, the collusion one, and listened to the whole thing. And then I actually had to listen to it again, because I was like, I must not understand what she's talking about, because this just sounds insane, right?
Really? Because we didn't even really get into, I mean, that's just on a way other, this is a global central bank, back and forth level. But yeah, it's there's a lot.
Yeah. Then the second time, it was just as crazy as I thought. And so now I'm at the beginning of All the President's Bankers. I'm like going backwards.
You know, All the President's Bankers is honestly my favorite book, and I say that with a new book coming out. And I should say that's my favorite book, and it is a good book for distortion. But All the President's Bankers was so, it took me into so much like original kind of documentation and research and analysis. It was like unfiltered, because it was stuff that was preserved from the years when it was happening. And so it was just a fascinating experience.
Yeah. And the whole time listening to Collusion, I was thinking, I can't believe this all happened before the pandemic too. So, and then, you know, knowing how everything's going now, it's like, oh my goodness. So it must be absolutely insane at this point. But all right. Well, thank you again.
Thank you so much.
Thank you.
Cheers.